Welcome to Trading-Pennies.com Chart of the Week, where every week we will examine the trading strategy behind one of our explosive daily stocks picks. All of our strategies are covered in detail in our manual, Learn How Professionals Trade the Penny Stock Market, available on our site at Trading-Pennies.com. This week's chart is Sirius XM Radio Inc, ticker symbol SIRI, a broadcasting company within the services sector. What caught our attention in this stock was the recent price volume activity relative to the degree in which it was oversold relative to its sector, industry, and the general market. As noted in our manual, a rising tide floats all boats, an old truism on Wall Street. The major indices, the Dow Jones, Nasdaq, and S&P, represent the collective psychology of the market as a whole. If all three indices are trading higher on a given day, it means that there is a pervasive buying in the markets and therefore a greater likelihood that if the stock you are watching breaks out of a key pivot point to the upside, it will continue upward. This concept holds true throughout the various sectors, industry, and bellwether stocks within them. The recent activity in the general market suggests the formation of a bottom. Whether temporary, such as the likes of a bull run in a bear market, or the first leg of a bull run in a longer time frame pattern, it's impossible to determine at this point. Regardless, it offers a profitable opportunity in the short term. The confirmation of this will depend on market activity over the next 4 to 7 days in the three major indices. This classic bottoming pattern signal will be covered in a future video. As this is forming though, so may be the bottom of Sirius. To this end, Sirius got our attention. On the daily chart, aside from a brief period of news-related volatility in early through mid-February, Sirius had formed a strong, low-volatility, low-volume base between the 0.11 and 0.15 price level. It broke out of the base on high volume last Thursday, and in position it consolidated above the 20-period Bollinger Band near the prior spike high of 0.23 going into close on Friday's trading. As always, we look to determine our risk-to-reward ratio for any trade by performing multiple chart analysis in multiple time frames, looking for key pivot points of support and resistance based on price volume action and pattern convergence. To that end, we see Sirius a good candidate, as there is a good degree of open air or little resistance in multiple time frames. On the monthly chart, we see the price level resistance at the 0.23 and 0.24 levels. Above this, the next significant resistance is convergence that occurs between the upper boundary of a downtrending channel and a downtrend line drawn off previous spike highs, which occurs at or near the 0.50 price level. On the weekly chart, we again see the price level resistance at the 0.23 level, and above this at the 0.36 and the 0.38 level. On the daily chart, we see both a wide channel drawn from the low and highs of the recent period of volatility in February at the 0.05 and 0.20 level, and the upper and lower boundaries of a narrow price channel at the 0.11 and 0.15 price levels as noted earlier. On the daily chart, we also see the upper and lower boundaries of an up channel, in which Sirius climbed the lower boundary of on its recent volume breakout. If the support of the lower boundary of the channel holds, which on Monday's trading would represent the 0.18 to 0.185 price level, the target of a price volume expansion, if this was to occur, would be the 0.28 price level. As can be seen, the 0.18 to 0.185 level represents convergence of the lower boundary of the current uptrending price channel and a price support level. Thus, we view the 0.18 to the 0.185 as a significant key pivot point on Monday's trading, and a break of this on volume would suggest our next key pivot point to be the 0.17 price level, as noted in the next slide. What makes the 0.17 price level significant to us was the formation of a cup and handle pattern on the intraday chart. In review, a cup and handle pattern is formed from the prior breakout. The high of the breakout forms the left side rim of the cup. As the stock pulls back, it forms the left side of the cup. During this period, it is likely that there is increased volatility, a greater price range among highs and lows and volume, in whatever time frame in which you trade. As volatility decreases, the stock begins to form a base. It is important that the lows of the base do not exceed 50% of the prior breakout range from the low to the high that formed the left side rim of the cup. A break of this increases the likelihood of failure of the pattern. The right side of the cup is formed by a gradual increase in price that does so on lower volume and volatility. The rim of the right side of the cup is formed slightly below, at, or slightly above the high that formed the left side. From here we look for the formation of a handle. A proper handle is formed when the stock pulls back on lighter volume and decreasing volatility, and the low of the handle does not exceed 50% retracement of the low of the cup's base to the handle's high. With regards to Sirius, the 0.17 level would represent the midpoint of the cup on an intraday basis, and failure of this would suggest a potential fill of the gap low at the 0.11 price level in future trading. We also see the 0.17 level to represent the midpoint between two significant price levels, the 0.15 and 0.18 on the intraday chart, as each represents a volume breakout points of significance. Lastly, we see the 0.17 level of significance on the intraday chart as it represents the lower boundary support of a 30-degree uptrending channel. If Sirius holds a 0.20 price level during opening trade on Monday, we see a good possibility for Sirius to advance to the next key pivot point at the 0.24 price level during Monday's trading. If it breaks this level, we will consider selling part of our position and suspect a retest of support at the 0.17 and or the 0.18 price level, with a volume break of the 0.17 as reason to sell the remainder of our current position on this swing trade. Lastly, on the intraday chart, we also see the development of a 45-degree uptrending channel, which tends to be less stable and more volatile and therefore less predictable to trade. Currently, Sirius is basing along support of the lower boundary of this channel at the 0.20 price level. A break of this is reason we will sell a portion of our current position, as noted previously. But if volume comes into this stock, we see a potential move to the next key pivot point at the 0.24 price level and a potential of the 0.27 level, as this represents the upper boundary of this channel. Until next week, from Trading-Pennies.com, this is Thomas McClellan, where our goal is to help you learn to become successful trading the penny stock market.